Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Manpreet, and welcome to the Through the Noise podcast. Now, today we're joined by Rajat, who regular listeners will know heads macro strategy at our chief investment office. I'd argue he's the right person at the right time, as today we'll talk about Europe and how to interpret the ECB's sizable rate hike. We'll also talk about China and whether the extended lockdown is something for equity investors to worry about. We will also talk about the UK, where, of course, we got the unfortunate news overnight of the Queen's passing, but we have a new Prime Minister, and we'll briefly touch upon the dollar yen exchange rate, and whether looks set to test its late 90s high. So, welcome, Rajat, and let's kick off directly with Europe. We had a big rate hike yesterday, but this seems to come against the backdrop of an economy where growth indicators, do appear weak. So, could you help our listeners understand why the ECB acted as it did, and how much more might yet be in the pipeline?
Hi, Manpreet. Yes, glad to be here. You're right that the ECB hiked by 75 basis points. It was a record hike, and that is because they're really focusing on inflation now. The singular focus on inflation, given core inflation is running at around 4% or more in the euro area. So the reasons we know now, it's really the energy shock coming from the cutoff in Russian gas supplies. Given that they expect remain high in the foreseeable future. In fact, ECB President Lagarde talked about another 75 basis points in the next meeting in October, and the markets are pricing around 160 basis points over the next 12 months. So the focus is really on inflation there.
So 160 basis points is sizable, but that's presumably negative for European equities and I suppose risky assets a little more broadly.
Correct, which is why we have been de-risking our portfolio for a while. In this second quarter, we downgraded equities from preferred to a core holding, and earlier this month we downgraded euro area equities because of the reasons cited earlier to less preferred from core holding. We are simultaneously actually moving up the quality ladder in bonds, so we downgraded high yield bonds in favor of the investment grade bonds.
Okay, so I guess scaling back to a more balanced positioning and de-risking, like you said, but help our listeners reconcile this with UK equities, where we have a much more positive view, because arguably a lot of the macro backdrop does look similar, with some weak growth indicators and a Bank of England that's hiking rates. But does the new PMNO policies have any impact on your view?
Yeah, it does actually. But you're right that UK and Euro area face similar challenges in terms of the energy shock, for instance. But what PM's Truss has done, the first thing she's done as she came in is to cap those energy costs for consumers. So that should help the domestic disposable income and support the consumer-based domestic sectors. There are three or four other things which lend weight to the UK equities call. The first thing is that FTSE 100, the index, the main index there, 70% of the earnings from in that index comes from overseas. So the weakness in the pound, and the pound has weakened significantly this year, it benefits the earnings of those companies. The second one is the dominance of the three old sectors. By that I mean financials, energy, materials, and these sectors account for almost 40% of the UK index, and they are going to benefit from the rising rates and the overall elevated global inflation backdrop. The third one is the cheap valuations. So UK equities are trading at around 9 PE 12-month forward, and that's at a 20-year low. It's a huge discount. It's almost a 36% discount today to global equities. Again, that discount is at a 20-year high. Now, the final point is high dividend yields. UK equities, we know, traditionally pay high dividends, but the 12-month dividend yield is currently at around 4.5% versus just over 2% for global stocks. So, as you can imagine, all these factors lend weight to our call towards UK equities.
But certainly a compelling case there. But let's go to the other side of the world in China. Now, this is one market where we've been arguing policy is being much more supportive by easing to support growth rather than the tightening we're discussing in Europe and the US. But Chinese equity markets, of course, don't seem as convinced. And we have the Hang Seng, of course, testing the 19,000 level. Um, do you see the case for Chinese equities still intact on a long term basis?
It is actually the near-term challenges. You're right that they remain, and the latest one being the lockdowns that we saw in Shenzhen or Chengdu, and also the government has announced tighter measures in the upcoming holidays. Then there is the CNH weakness, and that's partly because of the overall dollar strength. And finally, the ADR listing issues, the listing of Chinese companies in the US, and then the need for them to be audited by US auditors. Now, SEC recently came with a warning to US auditors that they need to scrutinize the integrity of the issuer's management closely when they audit. Now, all these are, near-term hiccups, but we see a lot of this fading away as we go through the year. So the big party congress is in October, and after the party congress, we see more moves to ease the lockdowns, the COVID lockdowns. The policy support continues as we've been highlighting. They've cut rates, they've been easing fiscally. More is going to come, at least we believe, after the party congress. And finally, the big point is the attractive valuations. Chinese equities, I mentioned UK equities earlier, but Chinese equities have equally attractive valuations. Within the whole space, we prefer the onshore equities because they are less susceptible to the geopolitical tension, and that's why we believe that they are going to benefit. And they also are likely to benefit the most from the domestic stimulus that are coming through.
Okay, and very quickly, while we're staying in Asia, just very briefly, Japan, of course, I mean, dollar yen exchange rate has been moving higher once again, and it's been argued that it's unlikely to turn lower until the Bank of Japan ends its ultra easy monetary policy. I mean, do you see a case for that to occur in the short term, or will the dollar yen likely have to test its 98 high of 147 before we get to a peak?
Yeah, the dollar yen is really a dollar moves for now because the momentum for the dollar is so strong. So we could see a test of the 147 that you mentioned, the 1998 high. Clearly, the BOJ is not budging in its policy to keep its monetary policy very, very uh, weak and basically supportive for the economy. Inflation is not a problem in Japan, and which explains why the BOJ is uh, maintaining its policy. But we could see some intervention in the near term from the government if the dollar yen hits the 147 mark, let's say. On the support side, I think there's a support at around 139.35. So that's the one we need to watch.
Well, thanks, Rajat, for that engaging discussion. I think a few sort of interesting takeaways, but we'll sort of bring that to a close at this point. And thank you, listeners, for, of course, dialing in. As always, if you'd like to read more of our market views, please do take a look at the Standard Chartered Wealth Insights LinkedIn page, where many of our team members, including the both of us, do regularly share our views. Of course, if you want a read of a more detailed reports, please don't hesitate to reach out to your relationship manager. So, with that, wish you a great weekend and we'll speak again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.